The real estate market is about to crash in 2024. All financial indicators are pointing to it. It's been more than 20 years since 30-year mortgage interest rates were as high as they've been this month. The 30-year mortgage interest rate is already at the level where the price came down significantly. An excessive mortgage interest rate, plus economic recession, and boom, we have a real estate crisis in our hands. Similarly, the data on U.S. housing affordability is already at historic high levels. From the chart, we're already below the 2008 levels, where a lot of homeowners defaulted on their mortgages and were foreclosed. The current market hike in mortgages since 2020 might be a trigger to a housing crash. Increased mortgage rates and steep home price growth have reduced affordability. So, if mortgage rates continue to go up while affordability remains low or continues to decline, boom, a crash is imminent. This time is more devastating because the value of houses has increased significantly compared to 15 years ago. Look at this chart. We are already at the 2008 levels of housing rates, and that's child's play to what's coming in 2024. The United States housing market is in its sixth major downturn since the late 1960s. In 75% of big cities, home prices have fallen monthly for 6 to 7 months. This presentation will highlight the locations where property prices have fallen the greatest and those that have been steady. We'll also compare the present downturn's depth. The most accurate home price index, the Case-Shiller Home Price Index, shows a national decrease that began in summer 2022. Traditional housing prices don't fall nominally. I'll discuss real or inflation-adjusted home prices later in the video, which is better for contextualizing home prices throughout time. Home values have dropped only 3 times in the last 30 years, according to the graphic. A 2% reduction occurred in the 1990 recession, whereas nearly a 30% drop occurred in 2008. Strangely, property values did not fall throughout the 2001 recession. National housing values are down about 3% from their summer 2022 peak. Recognizing geographical differences in real estate, some places have seen more than a 3% fall, while others are at their peak. We'll measure the home price fall and the correction's duration. Home values took 37 months to peak after a 2% drop in the 1990 recession. While housing values did not fall during the 2000 recession, they fell 30% during the 2008 recession and took 116 months to recover. Traditionally, the stage is set for a real estate downturn when there's a swift surge in residential property values, an uptick in the desire for housing, and a flurry of home flipping activities. Up until very recently, the real estate sector reveled in historically low interest rates, rendering homeownership more accessible. Yet, this frenzy of affordability has unleashed a storm of soaring property values. The unmistakable reality is that the appetite for housing is sprinting ahead of the available supply. What do you expect? What are the indicators for a financial crash in 2024? First, housing prices have gotten higher. Presently, housing affordability in the U.S. has hit a 4-decade low, with 30-year mortgage rates creeping towards 8%. Even when adjusted for inflation, housing prices have soared well beyond the levels seen in 2008. The truth of the matter is that nearly every market in the U.S. is grappling with overpriced properties. Interest rates have reached unprecedented heights, making affordability a daunting challenge, particularly for low-income earners. However, the mere fact that housing prices now surpass those of 2008 doesn't guarantee a bubble burst. The current market landscape presents a fresh set of obstacles and markedly different challenges compared to those leading up to the Great Recession. While it's not accurate to claim that this time is different, given the evident surge in housing prices, the underlying fundamentals have indeed evolved. The lending practices that fueled the 2008 crisis have mostly faded, and new factors now influence the market, adding layers of complexity to the current situation. Understanding these changes is crucial for anticipating the nature of any forthcoming correction. Let's delve into the distinctions between the housing landscape in 2008 and the present day. The 2008 housing bubble in the US was essentially a speculative frenzy, where houses were traded akin to stocks. It wasn't just trading, it was full-fledged day trading, where the anticipation was that of a short span, be it 1, 3, or 6 months. The property's value would skyrocket. However, this scenario unraveled when the housing market eventually collapsed. Fast forward to the prospective 2024 housing market bubble, if you will, and it's rooted in markedly different issues. While there's an element of speculation driving it, it's no longer solely investor-fueled day trading. The surge in prices stems from a significant shift in household formation, coupled with a considerable number of mortgages, still locked in at exceptionally low interest rates for the next 25 years, provided the holders retain them. The latter period witnessed a substantial increase in household formation, contributing to the prevailing supply shortage in real estate markets across North America. According to the National Association of Realtors, we currently face a shortfall of 6.5 million homes, a gap that would necessitate tripling housing starts, a scenario unlikely to unfold anytime soon, given the economic climate.